index is starting about 1/3% higher as well. So that's the overall picture, 24,950. So moving up a little bit more, about 1/3% or so. What do we have as far as market heat map, the open Nifty heat map is concerned? I mean, overwhelmingly positive, right? So tech is right there on top of the list. Infi, Wipro, HCL, TCS, Nimesh and Rima were talking about this one with regards to individual names, etc. And on the other side, it's financial services. I was talking about how Bank Nifty and that index has relatively underperformed. Very, very weak retracements. ICICI, Bajaj Finserv, SBI Life, etc. is at the other end of that, on that dashboard. So 24,935. Rima.
Well, the top 5 Nifty gainers all belong to the IT sector. Infosys leading from the front, a near 2% gain on Infosys. Investec today upgrades Infosys. Their target price is set at 1650. The stock right now is at 1655. That's the target price on Infosys. On TCS, JP Morgan has upgraded to an overweight. Their target price is 3,800. Currently, the stock is sub 3,100. But the rest of the pack, Tech Mahindra, Wipro, HCL Tech, also seeing buying, and gains range between 1 to 2%. Outside of that, you've got Trent, Hindalco, Ultratech Cement, NTPC, IndusInd Bank, which deserve mention. On the way down, ICICI Bank is weak in trade. In fact, Axis Bank is also under pressure. Kotak Mahindra Bank, HDFC Bank in the red. The cuts are not deep, but it's a red tick for some of these private sector banks, and that's pushing the Nifty Bank in the red down nearly about 35 points. And Bharti Airtel is correcting a bit.
Well, that's right. I'm not sure whether there's any news flow on paper stocks, but JK Paper is zoomed up. TNPL as well, that's Tamil Nadu Paper Company. I think that one as well, both of them moving higher on rather large volumes. So those are both top volume movers. Big move in both these two paper stocks. I'm not sure if there is some news flow that's come about, but keep an eye out on them. Cross, KROSS, well, that's up close to around 5.5%. That's a recent listing, if I remember correctly. Big move is what we're seeing on that particular name. A stock that's seen some follow-through buying is Apollo Microsystems. Well, that one, in fact, is moving very, very well this morning. That's up, I think, another 3%. Even in Friday's trading session, it moved on rather large volume. So now it's flattened out a little bit. So that's cooled off a little bit. But West Coast Paper, JK Paper, TNPL, all of them, they're off to the races. What's not doing too well is Belrise. I think that stock was down close to 100%. It opens up for trading. I think there were a particular number of stocks that were refrained from trading. Now, they are free to be traded, if at all. So that's why I think that one, in fact, is a little bit lower as we speak, actually flattish. Kitex Garments, that's down close to around 4.5%. So those are a couple of big movers in early trade. But a green start is what we wanted. A green start is what we have. The Nifty Bank underperforming yet again.
Okay, all right. We'll see how this plays out from here. But Pankaj Murarka is with us now, CEO and CIO at Renaissance Investment Managers. Pankaj, great to have you with us here. Thanks very much for your time, as always. I was right before opening, so two things, right? One, consumption, maybe mass consumption as a sector, perhaps as a theme, starts to pick up a little bit. I mean, that idea at least is entering the minds, maybe because that space is done badly and there are some triggers. The government seems to be pushing for consumption to revive. Would you agree and go along with that kind of thesis? And what would you do if you did?
Morning, Prashant. We've been talking about this. We've spoken in the past as well. I firmly believe in a recovery in the consumption. We've said that, we are coming out of 2 years of consumption slowdown in the economy. And more importantly, I think there are now enough triggers to expect a meaningful revival in consumption as we get into the festival season, because you see, starting from start of this year, in the budget, the government did a tax cuts of about 1 lakh crores, which is about 30 basis points of fiscal stimulus. And now on top of this, we have the GST cuts, which will add another about 30 odd basis points of fiscal stimulus. So cumulatively, there's been a 60 basis point of fiscal stimulus. And RBI has done about 100 basis points of rate cuts, which effectively translates into a monetary stimulus of 40 basis points in terms of savings on EMIs, on home loans, car loans, credit card loans, and everything else. So in a matter of about 6 or 8 months, we've seen about 1% of GDP as fiscal and monetary stimulus that's been injected into the economy. I think that's very significant in the context, and that should lead to recovery in consumption starting from the second half of this year as we get into festival season. we are, and I would think we would see a recovery in both staples as well as discretionary. So, consumers is one of our preferred sectors where we have significant overweight position at this point of time.
Okay, we'll come to that. Just a broader call, Pankaj, on the markets. This 27th August tariff deadline is looming in front of us Wednesday. Will this trigger a sharp market reaction, or do you think it's in the price now?
Rima, I don't think so. Markets will respond to this 27th August deadline in a knee-jerk fashion because markets are taking a slightly more medium-term view on the whole tariff subject. And as we all know, the tobacco trade has worked pretty well over the last 6 or 8 months. So eventually, I think President Trump will chicken out and probably down the road, there is a bilateral trade deal between India and US. It's important for India to not just, be submissive and probably negotiate. So all of us know that these are more negotiating tactics rather than meant to be longer term tariffs. So I think markets will overlook the 27th August deadline and look at the issue from a more medium term perspective. And I think from a medium term perspective, the effective tariffs on India will be much lower.
That's the hope, Pankaj. Let's hope you're right. But I recall that that big call you said that after a few years you're turning constructive on staples. So that seems to be in the limelight right now. So hopefully that call goes well for you. But the other comment that you had given me the last time around was on defense stocks. You're still not taking money off the table. Maybe you're in early. What's the view right now? Because we're getting those big orders that are coming in now. The Prime Minister is clearly focused on it, and the globe on the whole seems to be quite focused on defense spend. How do you approach this space?
Well, the ordering momentum or probably the growth momentum will sustain for defense companies, Nigel. I think at least there is fair degree of visibility for the next few years. But having said that, as I've been saying, that stocks are extremely expensive, meaning all those defense companies are trading at 50, 60 times 12 months forward earnings. And essentially, when you do a reverse DCF on these companies from a longer term perspective, they're pricing in pretty high, 25, 30% profit growth over the next 10 years. Well, I'm unsure whether these companies can deliver that kind of earnings growth over a very long period of time. So I think one should be careful in terms of owning or nibbling into these stocks at these levels.
But if you have it, you'll hold it?
Yeah, I think probably people owning it can probably hold it, but new buyers should be slightly careful because valuations are extremely rich, and buying companies or businesses at such extreme rich valuations for a longer term investor generally does not yield into healthy returns over the long term.
This overweight call on consumption, what percentage of your portfolio would broadly be in consumption, and which would be the subsectors that you have the confidence to put money in right now?
Well, Rima, consumption, from our point of view, we have a significant overweight in consumption. So across portfolios, we have about almost 14-15% of our portfolio into consumer space. And we're playing it through a mix of both, as I said, staples and discretionary. So we're essentially looking for companies which can grow above industry growth, and companies which are making significant investments to grow their business at a higher rate or probably take market share. So some of the companies that we own across staples includes likes of Godrej Consumer, and within the discretionary space, we own companies like Jubilant Foods and companies on the durable side, which essentially includes companies like Whirlpool and Crompton and Havells as well.
Yeah. No, point taken. Pankaj, what else? What else is on your radar? Are there lots of new listings, right? And some of them are interesting lines of businesses, Bunch has done well. Anything you've sort of latched on to? One argument I hear nowadays, maybe I don't know, is the relative market cap argument. I've heard it for a range of businesses that, this is what market cap is only $1.5–2 billion. Look at the industry leader. It's at 20 billion. Not even industry leader. It's at 20 billion, 25. I'm sure you've heard it as well. What do you make of that? And of course, in terms of new listings, anything, in terms of ideas that you'd want to share?
Well, these are kind of classical arguments which we get to hear in a matured bull market, which is where India is, where obviously we need to realize, Prashant, or concede that we are in the sixth year of this bull market, and India is the most expensive equity market in the world. So markets are priced to perfection, and obviously there is no apparent value on the table. And in this kind of a matured bull market, probably that's the only relative argument one could make. I don't think so. These kind of arguments hold much water for a value investor from a longer term perspective. Uh, Traditionally, Prashant, we have stayed away from IPOs because generally we like to spend a lot of time with the investing companies before we put our money to work. And because these companies we've not had a good amount of history with these companies, and probably our understanding of these businesses is not so great because these are newly listed companies, we tend to stay away from these kind of companies. Some of the other pockets of markets which I like is one I've always said this for some time. I'm still continue to remain extremely constructive on the internet space. I think India's internet ecosystem is on a high growth phase probably over the next decade. So companies within that space are still growing at 20-25%. And I think they can sustain that growth rate for the next decade or so. More importantly, these companies are very agile and they're making very quick pivots in their business to change business models and make changes in the business as they are required to. And many of these companies are now either profitable or are getting very close to being profitable in that sense. I think while we already have one company, Eternal or Zomato, which is part of the index, my views over the next 5-7 years, probably internet companies will contribute at least 10% of the Nifty index because many of these companies are consolidating their respective industry segment at a very rapid pace. And most of these companies are operating in a space now which has very limited competition, just 2 or 3 or 4 players kind of a thing. So effectively, the runway for these companies in terms of enlarging the profit pool is very long drawn. So that's one space which continues to excite us across our portfolios now. Internet is almost 10, while index weights is low, but in our portfolios, we have almost double-digit exposure to internet companies, be it food tech or fintech or some of the consumer tech companies. So that is one space which really excites me, and despite a cyclical slowdown in the economy, as I said, these companies will continue to grow at a reasonably high rate.
Food tech, right? The Swiggies and the Zomatos, etc. You think they can become much larger in terms of size over a period of time? Hospitals, Pankaj, any thoughts here? Again, it's a space which is completely re-rated last couple of years.
Yeah, I think the view there remains positive because there are enough drivers for that. All of us know in India, healthcare spends are, very low and they will only keep increasing. Hospital demand for beds just keeps increasing, and India now is also becoming a very favored destination for even patients from across the world coming to India for the low cost medical delivery that India can deliver. So I think, and that's again one space which is immune to economic cycles to a significant extent. So at this point of time, probably some of these are better plays in that sense because you're immune to economic cycles, be it interest rates or inflation, and they're still growing and probably will have a long-term growth visibility over the next 5 to 10 years.
Okay, let's talk about the entire IT sector that's leading from the front. The Nifty IT index now inching towards a 2% rally. Sudarshan in the morning was talking about the Investec note, where they're now seeing value and opportunity to make a 15% kind of return in some IT stocks. Sudarshan joins in with the details and what Investec likes.
So we are seeing a big move in both large cap and mid cap IT names in the opening hour trade. And today, Investec has come out with a note. It believes that risk reward profile has improved for most of the IT companies. And as per Investec, tier 1 stocks now offering more than 10 to 15% one-year return profiles versus limited returns that were expected earlier. And it's on the back of potential Fed rate cut and ramp-ups of vendor consolidation deals that are likely to aid growth, Investec believes. It has upgraded Infosys to buy from hold, and target has given is of 1,650. Also in large caps, it prefers Tech Mahindra, Infosys, followed by TCS. And in the mid-cap space, Emphasis, remember, is the top mid-cap gainer. Also, in Investec's preference, mid-cap is the top, followed by Zensar and KPIT Technology. There is also another positive note on KPIT Technology as well, and the stock is up currently more than 2%.
So are all these these price targets, they're all what, 10-12% upsides? So more tactical in that sense?
Correct. So on the Infosys, it's the second positive note that we have got in the last 2 to 3 days, and the target price is hovering somewhere in the range of 16 to 1650 and indicating or implying an upside of around 10 to 12% or more than that from current levels.
9% now. After Infosys has moved about 2%, Investec's target price 1655 is a 9% upside.
Marking to market. All right. Well, thanks very much, Sud, for that. Well, as the 50% US tariffs kick in on the 27th of August, Parikshit is here with key updates in terms of what's the state of play currently, because this is kicking in, and Parikshit looks, back channel or in terms of talks or what we're hearing from both sides. I mean, tell us, what are you picking up?
Well, back-channel negotiations continue ahead of the August 27 deadline. We're told that every effort is being made to get some sort of deal or understanding before the 27th of August. And there are overtures and messages of advice coming from the U.S. government as well. There have been conversations between the Indian government and top Republicans. In fact, we spoke to top Republican congressmen who told us that India must try and help the United States in ending the Russia-Ukraine war. That would be seen very, very constructively by the U.S. government at this stage. Former U.S. presidential candidate Nikki Haley has also said that India must take Trump's stand on Russian oil very seriously and work with the White House to find a solution. Commerce Minister Piyush Goyal, on the other hand, has said that they are addressing the issue of trade with the U.S. with a very open mind and a positive outlook. And this is a very consequential and very important relationship for both nations. External Affairs Minister Jai Shankar reiterated over the weekend that India has certain red lines on agriculture and dairy, and those cannot be compromised. An important development that has taken place is that Donald Trump has nominated a close confidant and a member of his inner circle, 38-year-old Sergio Gore, as the next U.S. ambassador to India. He will be stationed in New Delhi and also oversee missions that the U.S. has across South Asia and Central Asia. So it will be very important for India to be able to negotiate and put its voice across to a man who is directly part of the Trump inner circle. But that ambassadorial appointment is still a few months away.
Thank you very much for that. Back to talking about the IT companies, but this time the auto ER&D companies, because Motilal Oswal has written a note on the auto ER&D companies, the three of them, KPIT Tech, Tata Elxsi and Tata Tech. They're bullish on KPIT Tech. They've got a buy rating, and that stock has moved up close to about 2.5%. The reason is because this has been a fast-growing company, and they expect the company, KPIT Tech, to continue to grow at about 15% from FY25 to FY28, which will take the top line of the company to nearly $1 billion. And there is some scope for margin expansion to about 19%. But on the flip side, they're not very bullish on Tata Tech and Tata Elxsi. In fact, they've got a sell rating on both Tata Tech and Tata Elxsi. The reason for that is, for Tata Tech, they've got a target price of 580. One, they've got lower margins versus peers. Two, a dependence on the Tata Group companies, and even the growth prospects are fairly modest. Tata Elxsi 2 is a sell. Target price is 4,600. One, EBIT margins for the company have fallen significantly, and they're unlikely to get back to those historical peak levels. Revenue growth is moderating. This is a company which grew 18% in the past, FY20 to FY24, but now they're saying it'll only grow about 8%. There is weakness in Europe. Some of the large contracts are seeing a pricing reset. And they also have presence in media and healthcare, not just auto, where they're facing some headwinds. So Tata Elxsi and Tata Tech sell. KPIT Tech, Motilal Oswal is bullish, and that stock has moved up.
Okay, all right. Well, let's focus on the defense space then. We have Sachin Agarwal, the Chairman and Managing Director at PTC Industries, who joins us on the show. Well, we'll be focusing on three main points: the company's defense sector opportunity, the commissioning of the new facilities and capex, and finally, we'll also be keeping an eye out on the order flow inflow expectations for the remainder of this year. So that's going to be all the top points that we're looking at. Well, let's get in the management then this morning, who's joining in on the show. Hi, Mr. Agarwal. Good morning. Thanks a lot for joining in. Well, things seem to be coming together for you. And, if you look at it on a trailing basis, your stock looks rather expensive. But you have talked about big prospects in the coming years, and the street seems to be buying into that. I think earlier you were guiding for around 750 crores for FY26. You stick to that?
Yeah, as I mentioned last time, I we said that we will be doubling our revenue from the previous year for this year. So we're still on track for that. Yeah. So a very good morning. Yes, I think the prospects are very, very good. We already have an order book in excess of 700 crores to fulfill our targets for this year and for the next year as well. The order book is building up very fast. As you could have seen, the new press release related to Pramos getting in excess of 100 crores of order, not just from the domestic sources, but also from the foreign OEMs as well. A lot of long-term agreements and orders are in pipeline, which we envisage to be in place in the next 6 months or so. The capacity build-up and the execution of our new facility is also going on a very, very fast pace.
Okay, all right. Mr. Agarwal, let me push you a little bit more then. 750 crores of revenues. What about margins? Earlier, you were talking about, I think, margins in excess of around 20%. The start of the year has been soft. Maybe a couple of one-offs have impacted it. But on an average for the year, what should margins look like?
Yes, as I said, doubling the revenue, so that's not 750 crores, that's in closer to 700 crores.
700 crores, okay.
And margins are going to be similar on the same line as what happened last year. Overall margin in excess of 20%, closer to 25% EBITDA margins. Now, if we go further beyond as the pipelines are built up and the revenues increase, this EBITDA margins are going to increase over the next 5 years to be in excess of 35% blended margin.
So FY26 margins 20 to 25%, maybe closer to 25%.
That's right.
But in 5 years, it should go up to 35%.
That's right, or in excess of that.
Or in excess of that. Your order book, you said, currently is 700 crore rupees?
Yes,
what is the expected order inflow for FY26?
So we're expecting from domestic sources an additional order book of domestic requirement of excess of around 200 crores. But foreign order book is going to start building up next year, which will be, including long-term agreements, will be quite sizable, I would say, in excess of 1,000 crores or more than that. Depends on how long a term for the order book we look at.
And you also spoke about how the companies, there is some capacity expansion underway, which supports your target of doubling revenues and the growth outlook going forward. By how much does your capacity go up? How much have you spent so far? How much more on the anvil?
So we are currently investing in our, what is called our strategic materials technology complex, where a full end-to-end solution manufacturing, right from materials manufacturing in titanium and superalloys, to components, to machined parts, to forgings, rolled parts, raw products is being set up. This is a massive capacity and will be very, very unique in the world. And that is where the foreign OEMs have a massive interest in our facility. Even the new AMCA engine, if you can imagine, all these aero engines have almost 80% of the products which are material which is going in various forms, either in titanium or superalloys. And we are the only ones in India who have the capability to manufacture all these materials in various forms. So going forward, I think the margins as well as the top line is going to grow. The titanium material facility is a 6,000-ton facility. There is a superalloy facility. Then we have superalloy and titanium casting facility combined together close to 600-700 crores, 600-700 tons capacity. Forging products. So there are multiple projects. So the capacities for them are different. That's why we are foreseeing that, as I said, we are doubling the revenue this year. But in the next 5 years or so, the revenue from the previous year will be 10 times the current or the previous year's revenue. So there is all these capacities will be coming into place over the next 1 year, 1.5 years. So once that is in place and certain certification work is completed, then a massive ramp up will happen.
You said your revenues will go up 10x in 5 years?
That's right, yeah.
Okay. So this is from the FY25 revenue of 300 odd crore?
Yes,
okay.
That's right.
So by FY30, we're looking at 3,000 crore of a top line.
3,500 crores.
Oh. All right. Thank you very much for joining in. That's the word coming in from PTC India. Well, just a quick word on the markets. Higher, 100 points up now on the index, 300 points up on the Sensex. IT continues to lead from the front, and Bharti Eternal are seeing some softness.
No, absolutely. And just a couple of names I want to highlight, right? Markets, as you said, the index has moved higher. Cross, which is a fairly recent listing, KROSS, that is the top volume-led gainer on the NSE now. It's up 8.5% odd. So big one. Newgen is up about 7%, 926 on it. Our systems had, I think, a very good Friday and Thursday as well. So our systems is up 10%. JK Paper is up 12-13%, but typically, it's never one paper stock. So maybe we should look at some of the other paper names. Yeah, you got a lot of other paper names which are moving higher. Not a lot, but at least I can spot West Coast Paper, which is up 10%. Actually, it's true. We should put this up as well. So JK Paper, West Coast Paper is up 10%. You should look at Tamil Nadu Paper, which is up 13-14%. And I'm sure there'll be more then, Padmaja Paper, 8% higher. Volumes are a little low, but you got these paper names which are moving up as a pack, and we'll have this up on the screens. What else? Emphasis is up about 4% or so. Ismo, which is that company where, of course, it went up from 400 to 600. 400 to 600 in 3 days now. IZMO. So that is that's sharply higher. Astra Micro is up about 4%. All-time plastic. We highlighted this last week when you had a prominent investor buying in. So 4% up on all-time plastic, 329, 330 or so on that one. Lots of new names into the mix as we go through the session and look at the first couple of sort of trades coming through.
Nazara
is down. Yeah, Nazara is down 6.5% now. So that's actually the second biggest volume-led loser right now, Nazara Tech. So the price was 1,400. Right before that order banning, the bill banning online real money games the information came through. From 1,400 stocks down to about $1,070. So it's like just been a one-way collapse, which we've seen on Nazara. We'll take a quick commercial break here. We're going to come back with the management of V-Mart Retail. So they join in to talk about their business, and we're talking about consumption, right? So we'll ask Lalit what he thinks is going to happen. Stay tuned.
Welcome back. Max Healthcare and Interglobe Aviation, which make their way into the Nifty as a part of the rejig, Those stocks, though, are seeing a bit of profit booking today, but Max Healthcare has had a solid run, 43% up in the last 1 year, and Interglobe Aviation, too, has been quite the wealth creator, 33% up this year. In the last 1 year, too, it's up nearly 30%. So these are the entrants into the Nifty, but today seeing a bit of profit booking. L&T. That's the other stock that we're looking at. It continues to get good order flow, says the chairman and MD, S.N. Subramaniam. He's also betting big on the company's real estate business, and a potential listing could happen in a year or two. Speaking exclusively to Lata, the L&T chairman said work is in progress to improve the return on equity to 18%.
Today, the backlog of orders to be executed is more than 6,25,30,000 odd crores. Which means from an EPC point of view, we are more than 2.5 years of work as we look forward. And these are fairly fast-track orders in the sense many of them have to be done in 2.5 years, 3 years. So as an organization today, we seem to be on a firm footing. We have 5 orders from NTPC for boiler and turbine. We have 8 orders for boiler and turbine from Adani Group. And in a short while, we expect some more orders. Any rationalization being attempted will be helpful. I'm extremely happy that the government is thinking about it. And if they do this rationalization, it's another positive step towards, in my view, ease of doing business. When we talk at the management level, our executive committee level, at the board level, we focus on return on equity. We have from 12% we have pushed it to 17. I'm reasonably confident there was an internal target of getting to 18. We will do that. So the thought process is there. We have there were multiple companies, obviously, various SPVs so formed for various reasons to do it. We are putting it all together. We have formed a board. Some eminent people have come onto the board beyond our own internal people, including me. There are some very good external people, independent directors who have come. So we're trying to give it a shape and size to move it forward. In my opinion, where 26, 27, 27, 28 early is when we look for an IPO on that. IPO or over the counter sale, I don't know, but we will decide. Because that has to be taken to the board, and board has to approve in what form and which form we want to take it forward, but that's the plan in the mind.
Okay, well, L&T Real Estate as a separate company, well, there's a plan to listing, as you heard from the top boss at the company. Well, Yes Bank, I just want to quickly revisit it with Gaurav, who's standing by. Gaurav, take it away.
Well, Yes Bank definitely is in focus, and the reason being that now SMBC has gotten approval to acquire up to 24.99% stake in Yes Bank. Now RBI has also made it clear that SMBC will not be classified as a promoter entity, and that is something that we should be watching out for. If we go back in history just 2 months back, and if we look at the transaction, SMBC already gave a proposal to acquire around 20% stake in Yes Bank from multiple banks. Now remember, these banks had acquired the share of Yes Bank at a price of around 10 rupees, and then SMBC acquired it at a price of around 21.5 rupees per share, which leads to around 13 crores, more than 13,000 crores of investment in Yes Bank for the 20% stake. Even after that stake sale, we have big bank like SBI who will still have around 10% stake, and LIC who did not participate in the stake sale last time, he is still left with around 4% stake sale. So it will be interesting to see how the remaining 4.99% will be acquired and at what price it will be acquired. If we look at the timeline, and again, when we look at the transaction, it is not a surprise to investors, and the reason being that this was speculation already. In fact, on 16th of July, we had reported that SMBC is looking to acquire around 4.99% stake in Yes Bank. So definitely, it clears off the speculation now. And RBI commentary earlier also suggested that they will be okay if the proposal comes to them for the bank to get acquired up to 26%. So definitely this was not something which came as a surprise. Now the next trigger that we will be watching out is the appointment of MD and CEO. Remember, he was reappointed till April 2026 in the shareholders meeting. So definitely we will be watching out on if there will be any changes, if the new MD and CEO will be appointed. But as of now, a positive news trigger, as SMBC is not allowed to acquire around 25% stake in Yes Bank.
All right, Gaurav, thank you very much for that. Well, let's just focus on V-Mart Retail as promised. Now we have the founder and managing director of the company, Lalit Agarwal, joining us now. I'll just quickly outline what we want to discuss with Lalit. Three major points, basically, we're going to touch upon: the impact of the potential GST rate reduction, demand outlook for the festive season, and finally, the concerns on rising competition and how that is likely to affect V-Mart's business. Lalit, good morning. Great to have you with us here. Appreciate your time on the program. with regards to apparel, of course, we know the basics, right? What reports are suggesting. We moved to a two-tier system, etc. So the current GST rate essentially is 5% on apparel priced below 1,000 rupees and 12% on apparel priced above 1,000 rupees, and that 12% perhaps goes to 5%. Could you give us a sense on what proportion in value terms for V-Mart what you sell is apparel priced above 1,000 rupees retail?
Good morning. Largely V-Mart is catering to the lower middle class. So largely our focus is towards the lower segment of the society, which is the lower ASP. Our average selling price is right now 340 rupees. So we are, almost 85% of our products are sold at by units are sold below 1,000 rupees. But there are only 15% which is sold above 1,000 rupees. But in the value terms, if I look at it, this 15% becomes 30%, and 30% of the contribution mix in value is largely coming from items which are above 12% or above 1,000 rupees.
So, sorry, just repeat those numbers for us, Lalit, the last bit.
15% in quantity and 30% in value is above 1,000.
Okay. 30% in value is above 1,000 rupees. So, and that's the expectation, Lalit, from your side as well, that this 12% of this 30% goes to 5? The rate goes to 5?
Yeah, that's what we believe as the indication is from the government and from what the Prime Minister said from the Red Fort. I think this is very much clearly going to be a populist measure and also making economic boom coming, and because the consumption needs to grow as the textile sector is getting into a slight bit of pain due to the import tariff of US. So I think it's a great move, and it will definitely boost consumption if entire 12% or the 7% extra GST is actually passed on to the consumer. But there may be some caveat because we need to bring in the backward calculation, the backward yarn, as well as the whole processing, the services. All of that is still falling into 18% category. It will become then difficult for them to pass the same benefit to the consumer.
So in your case, what does that mean? How much is private label for you, Lalit? In terms of, so how much would the back end?
Almost 70% of the business that we do, greater than 70% is for the private label.
Okay, so then you make it on your own, right? You get it made, essentially.
We get it made, but what I'm trying to witness or give you a fact is it is a constituent of multiple processes and multiple fabrics and raw material which goes into the final delivery of a garment or apparel. So all those man-made fiber, the cotton yarn, all of those dyes, those processing, those services imposed on those, the rentals, everything then ultimately reflects on the pricing. So all of those also needs to get similarly lower priced. If they remain
for this full benefit, for this 7% benefit to completely be passed on, if it happens,
yes,
right?
Yes.
So the other, in terms of other costs, we don't know. But since this is GST and 3rd and 4th of September is when the meeting is, they will, I think, look at everything in that sense.
That's what we believe, because otherwise what happens is...
Correct. So which is the other...
lot of GST credit. We as a retailer accumulate a lot of GST credit, and that becomes a cash flow issue. The cost definitely goes down, but the cash flow becomes a big pain, because even today, we've got almost greater than more than 100 crores from the lying with the GST department, which we will not be able to take the refund.
Yeah. So which is the crucial on just GST, on the value chain? Apart from what is charged on the apparel, what needs to happen specifically for this to really show through? When we're talking about whether there'll be a boom in consumption, etc., it depends on what the taxation is on the value chain, on some of the items before it gets to the apparel stage. So which are those, and what's 2 or 3 crucial ones, in your opinion? What needs to be corrected?
I think those polyester yarns, those fabric, all of those man-made fibers, those yarns which are also getting imported. So there are a lot of those, then those dyes and chemicals, all of those, and then the contract, the whole services GST, which is also 18%. And then there's a lot of labor and there's a lot of contractors which are on the job, logistic on the job. So there is, and then for a retailer, we need to sell them, and then most of the services that we acquire, whether it is a rental service or it is a contract service or advertisements that we take, so everything need to be paid as a 18% GST, which is an accumulation of a lot of GST. And even for us, the store, what we make as a store, the capex that we involve, there are items which are 28% and items which are 18%. So a lot of GST gets accumulated in the capex as for the capex also. So there is so much of delta which gets created, but that doesn't get passed on to the prices. And ultimately, if we don't pass it on to the prices, the consumer will not get the benefit.
Got that. So that's on the GST bit. Just one word. You said the GST credit sitting is now more than 100 crores for you.
Yeah.
When do you typically get that money back?
We don't get that money back because as a growing organization, we always keep investing in new capex and new stores, and we keep investing in new inventories as well. So our inventory goes up, our capex goes up, and whenever our capex goes up, the rate of capex is 28%, 18%. It always is higher than my outgo tax product rates. So that is why the accumulation will always keep happening. It is negative for us as a retailer who sells value retail and who sells product at 5%. I'm just trying to, and this is a great news on the consumption side. Definitely, it's a populist measure. From a 12% to 5%, it definitely boosts more consumption and gives a better pricing to the consumer who is trying to consume a better product.
Okay. Can you give us an indication of how growth is? In Q1, I think your SSG growth was fairly muted, just 1%. What are the current demand trends? Has SSG picked up? Are we looking at mid-single digits, high single digits? And what is the anticipation for the festive season?
I think as of now, this particular quarter till now has been fairly okay. It has been positive, but not very high positive, because this year, at least we've seen a very good monsoon coming in, and monsoon brings in both the disturbance in the movement and mobility, as well as good crop. So I think what we are focusing in is the future potential of this monsoon, which will actually bring in lot of revenue and bring in a lot of prosperity in the markets where we operate. So we are very bullish on the festival because of monsoon. But as of now, there are temporary disturbances because of monsoon as well, which is not giving a great effect. But yes, we have a positive EBITDA, which is positive like for like, which is there.
Yeah. Okay. Got that. In your opinion, all said and done, you've run this business a long time, Lalit, and you know the ins and out. If this GST is done, right, and it's not tinkering, it's kind of sweeping, right, and they really, I mean, not tinkering, but two rates, and then all these differentiation within product categories, etc., go away, and that was the original kind of idea, right? Low rate, which leads to better compliance, and it's more costly to avoid than to comply. And then that leads to tax buoyancy. So you get that, say, for example, with this GST meeting. Do you think it can lead to a multiplier effect, consumption-wise, Lalit, in a durable kind of way? What is your sense?
I do believe that there are two things. I think one, definitely the price to the consumer is going to be low. So consumer when got benefited, and the price will be deflationary. So it is definitely going to help more unit consumption, and it will definitely boost the consumption. Number two, it also there's a fact that this rate going down. It is also bringing in a signal. The signal is very, very positive, which is trying to generate more consumption. But yes, I think all of this is a good driver to boost our internal consumption and our domestic consumption. It should definitely lead us to better growth.
Okay, all right. We'll leave it there, Lalit, and we hope that it's really a sweeping kind of rationalization, simplification, which we see, and really would love to have your expertise and inputs going forward as well. Sorry, you want to make a point, Lalit?
I wanted to make one point, yeah. So the second point which I wanted to make was there will be more people from the informal sector, which is the people who are still not registered with the GST, to move into this sector if the GST rates get simplified and the rates are very lower, because ultimately to manage a parallel economy is also very difficult. So I think the economic growth of the economy will look very good as there's still a lot of informal sector, which we see in small town, where a lot of retailers, a lot of business people still work on those parallel economies.
Yeah. No, as I said, I mean, the cost of avoidance has to be higher than just sort of, working within the. So I think that's the idea. Well, let's hope we get to it. As I said, Lalita, I hope you join us on the 3rd and the 4th, and when the decisions really come out, to talk about this further. Thank you very much once again. Okay, all right. That's V-Mart in focus there. 60 points on the Nifty. 24,930 is where we are at, and it's looking. It's looking okay. Lots of single stocks moving around, and I think it's similar to what the kind of price action we had through the course of last week. No real common thread running through the last 5 sessions. Very disaggregated, but big moves. I mean, if you sort of stack up returns for the week, but as I said, scattered and disaggregated and no common thread. And I think today's session is something similar as well, except those paper names. I don't know what's happening there. We'll try and figure out if there is a trigger. But usually moves as a pack, and that's what's happening. And I think more names have been added to the Andhra paper is up 9, Mallu paper is up 9, and Star paper is up 7.5%, Shashasai is up 7%, Orient paper is up 7%, and 3 or 4 other names I can see, JK, etc. I mentioned earlier, Tamil Nadu I mentioned earlier. So that paper stocks buzzing as a pack. Vinay Rajani is with us, Senior Technical and Derivative Analyst at HDFC Securities. Vinay, good to have you with us here. Thanks very much. In terms of trades and how to position yourself now, what would you recommend?
Yeah, good morning. So in last 2 trading sessions, we have seen a correction of 300 points from the recent peak that was 25,153. So Nifty has basically given respect to the 61.8% retracement. But Friday's low was around 20 and 50 days EMA, and also there is an upward gap area which also gives support to the Nifty, which is in the which is between 24,673 to 24,850. So there are cluster of supports which are lying around 24,850, and we believe that this is a correction in overall bullish trend. So no doubt the positiveness of the GST came last week, and after that we saw a profit booking. But again, I think Nifty is about to resume its uptrend, and 24,850 is a very strong support, and one should remain bullish. And advanced decline ratio is also not that bad. And in fact, broader markets are performing better than the benchmark indices. So I feel that overall market should remain firm. Stock specific bullishness should be there. For the Nifty, 24,800 should be the stop loss in trading long position. On the upside, I'm expecting Nifty to cross 25,160 in coming days. So overall, this is a buying opportunity, I feel, with a stop loss of 24,800.
Okay, all right. What about individual stocks? What's on your radar?
Yeah, so today IT stocks are moving very well. In fact, they started recovering from the lower levels and now getting some participation back. So overall, I think emphasis, which I also recommended in the previous session, today also it is looking good because it is one of the outperformer in the IT space also. So emphasis is looking good around 2940. Stop loss can be kept at 2880. I would recommend a target of 3020. The second pick I would choose from the fertilizer space, which is Chambal Fertilizer, which is quoting around 567. So nice setup is there from the 200 days EMA support. It is bouncing back. So this entire space has been outperforming. So Chambal Fertilizer at 567 can be traded long. 553 should be the trading stop loss. On the upside, I'm expecting a target of 585 in next couple of sessions.
Thank you very much for that. Get into break. On the other side, Manisha Gupta will focus on the commodity space. Stay tuned. Welcome back. Let's talk commodities now. Manisha Gupta is now joining in. Manisha, what's the one commodity that you're tracking today?
Well, I'm looking at gem and jewelry sector, Rima, because this sector really seems to be panicking right now with the tariffs coming in at 50% from 27th of August. It was 25% levied on 7th of August. And before that, in the month of April, the sector also was looking at 10% of tariffs already levied on them. So with 10% as well, we were doing various stories on how it's impacting the gem and jewelry sector, where the margins are low. And then 25% and 50%, the industry tells us, is a disaster and a no-starter for overall as a segment. Remember, $48.2 billion of India's merchandise export will attract tariffs. This is as per the parliamentary response that we saw coming in from the ministry. And overall, the number that India does is $190 billion of a bilateral trade with US. 5 rounds of US-India negotiations have been done, and the 6th round, which was anticipated in the 3rd week of August, as of now has been put off. The markets really are looking at US with a lot of hope, really, because the US accounts for $10 billion or 30% of India's annual exports to the US markets there. And there are various countries with lower tariffs where the markets do believe that you could be looking at business shifting to. Countries like China, Thailand, Turkey, Vietnam, Italy have lower tariffs from where India stands. So as of 27th of August, if India does get into 50% of tariffs, we would be absolutely not competitive as compared to Turkey, Vietnam and Thailand, where the tariffs are anywhere between 15 to 20%. We are much higher there. And then when you look at the overall markets there, when you look at diamonds, India is the world's largest hub for diamond cutting and polishing. 9 out of 10 diamonds are cut and polished in India. So these exports to US, which is, by the way, 50% of our diamond market, also will get quite strongly impacted. If you look at the overall tariff impact, then this will, to begin with, increase cost of Indian exports to the US. It also does impact India's products, which are now less competitive and lead to lower sales. So we already are looking at those calculations coming in. And then it does threaten livelihoods, stalled exports, and disrupted supply chains as well. There's various reactions that we've seen come in from industry in last couple of months there. The latest clearly being that it will impact not just the overall exports, but we also are looking at industry calling for government intervention, including strong diplomatic talks continuing with the US there. Also, there is an ask from the government for special schemes to support exports, the exporters as well, and especially the small units. The small jewelry houses, small diamond houses and export units is something that could really get hurt. Looking to also, the industry tells us that they're looking to shift their manufacturing to lower tariff nations. A lot of jewelers that I know and exporters as well are as of now traveling to various countries like Dubai, Mexico, even Europe for that matter, trying to understand on if they can actually shift their manufacturing businesses from here to there. The industry also is warning of potential job losses for nearly 5 million workers in the street there. Apart from that, the workers did shift to the lab-grown diamonds, but that area also is looking at a hit right now because that also comes under a 50% preview. Apart from that, the markets also are looking at SEEPs, which, by the way, employs nearly 50,000 people and has 200 exporting units. So various concerns, really, and there's a lot of long list that the industry has sent to government in sense of reliefs, incentives, even subsidies for that matter. All of that, as of now, is...
Okay, all right. Thanks a lot for that, Manisha. Well, I'm focusing on JSL Stainless, Jindal Stainless. The stock is high in today's trading session, and there could be 2 broad reasons. One is a technical factor because the stock is going out of the FNO post the August series, which is in a few days. So there could be some shorts that are covering out. The other factor is the fundamental factor. Outokumpu, they have gone ahead and raised surcharges of stainless steel flat products for the month of September itself. Remember, the company is a leading stainless steel manufacturer in Europe that's based in Finland. The rationale that they're given is combination of improving market demand, and they're also quoting higher raw material costs. So because of this, that European producer has gone ahead and increased prices. Now, this is a mild positive read-through for Jindal Stainless because exports as a percentage of their mix have come down to around 9%. And keep in mind, a couple of years or so ago, it was closer around 17%. So the export market has been, not panning out very, very well for them. But if a leading supplier is going ahead and increasing prices, citing better demand, it gives them a bit of an opportunity. And maybe the street believes there's an outside chance that could be some duties as well that could be coming in from the Indian government to protect them from imports. So 3 factors going out of the FNO ban. You have European producer that's increased prices and some hope of maybe some duties that could protect the domestic industry.
I just want to make a quick mention that I was talking about paper stocks all rallying, right? I mean, 4 or 5 these names are up 10, 12, 13%. Vamakshi tells us that the government has imposed minimum import price, MIP, minimum import price on virgin multi-layer paper products. And they amended the import policy under Chapter 48. So I think this is the reason why, and this I think apparently happened on Friday. And this is the reason why you've got stocks which are all rallying hard. And I think we'll be able to sort of, get you a detailed perspective. We should actually dial up paper companies as well and ask them what this does for them, because stocks definitely are reacting. Okay, the other bit is CRDMO companies, and Jefferies has got a note out and a view. Ekta is here with details. Ekta, morning.
Well, yes, Jefferies has written on the CRDMO market. They've said that India's CRDMO industry is at an inflection point, from being known as a cram sidekick to now being in the global limelight, and is evolving from a quasi-chemicals firms to strategic partners for innovator companies. Now, this is backed by capabilities and geographic diversification, according to them. Now, Jefferies also believes that the China Plus One is a structural story. It can drive high-teen revenue CAGR for the next decade all. Overall, they are expecting 18% CAGR during FY 25 to 30. China Plus One can be an annual $700 million sales opportunity in the base case, and it can hit $1.4 billion in terms of a bull case. The key risk, according to them, is in-licensing deals by Big Pharma with China. Now, they've initiated a buy on Cohance with a target price of $11.50. Cohance, according to them, has an ADC-led pipeline, which is basically anti-drug conjugates. Upgraded Divi's to buy with a target price of $7,150. They think Divi's has a blockbuster GLP-1 contract list. SciLife is a top pick along with Piramal Pharma, which is a buy. And according to them, Piramal and Sci have strong late-stage portfolios.
Right. Thank you very much, Ekta, for that. Really appreciate it. Well, let's just take a quick commercial break here. On the other side is a special segment, is the economy. Lata speaks with Rikin Shah, the banking analyst from IIFL, on which banks stand out after first quarter earnings. Coming up.
Welcome. This is a banking sector special. The Nifty Bank was actually leading the Nifty in gains all the way up to June. But post the Q1 results, it appears to have lost its mojo. This month, that is in August itself, the Nifty is up only 0.5%. The Nifty is up 0.5%, while the Nifty Bank is down 1.5%, data as of Friday. Now, is this because of the results, or is it the series of rate cuts, or is it that credit is slowing down? To analyze the outlook of the banking sector, I'm joined by Rikin Shah, the Senior Vice President and banking sector expert at IIFL Capital. Rikin, thank you very much for joining me. Rikin was to actually join me in the studio because we were going to read out this excellent report that he put out last week. I mean, it's one of the most comprehensive and most brilliant reports I've seen. We would have loved to have you, but the rain is just impeding all movement in Lower Parel. Rikin, thanks much again. Well, first up, to cut to the chase, you're speaking about margins bottoming out by the second half. But there are a significant number of economists who believe another rate cut could come not necessarily in October, but maybe in December or in February. Have you factored that in? One or maybe even two more rate cuts?
Hi, good morning, Lata. Thanks for having me on your show. So answering your question on the margin outlook, given the full impact of the 100 basis point of the repo cuts that have happened, we are of the opinion that the margins start stabilizing around 3Q and then improve from 4Q. But that naturally doesn't take into account any additional rate cuts. Our house view at the moment is that we could potentially be looking at 50 basis points of total rate cuts in the next 6 to 9 months. And in that backdrop, if that were to happen, the financial year 26 earnings growth for the sector, which we are projecting it to be -5%, will further drop down and could be closer to -7 to -9% YOY earnings growth. But having said that, I think to provide a context, this is not a structural margin pressure. Whatever we lose in terms of the margins this year on account of additional rate cuts from here, we would recoup a lot of that in FY27 itself. So my FY26 earnings go down, but FY27 earnings growth would even look better when the liabilities start repricing with a lag.
Now, I take your point that, it's just that the deposits will start getting repriced a little later. But let me come to credit growth. You are a little worried about, everyone is worried about the credit growth in the current year, but this is pre-tariffs. Now, after tariffs, the expectation may not be that credit growth will necessarily pick up in FY27 itself. Is that factored in? What kind of credit growth and earnings growth are you therefore penciling in for next year?
Sure, Lata. So in terms of the credit growth, the currently banking system is growing around 10% YOY. We are of the camp that while there could be some modest pickup in the growth, it is unlikely to rebound very strongly. So our loan growth projection is only around 11%, and there are a few factors why we believe that growth is not likely to accelerate significantly. Number one, if we've done this study for home loans in India across the last 2 decades, counterintuitive to the common perception that when the rates go down, the home loan demand goes up, we have seen that the home loan growth actually decelerates when the rate cuts happen. It's not a demand issue, it's a supply issue for the banks because these are a very low margin and low ROA products. So the willingness of the banks or HFC to lend in lower rate environment is lesser, and hence the loan growth decelerates. The evidence of that is that already in this past few months, we have seen the banking system loan growth for home loans going down from 16 to 10%. So that's number one reason. The second reason, again, is the corporate credit growth. While the common perception out there is that the corporate credit growth in India is very weak, we actually argue that it's not weak at 9-10%. It's actually ahead of the long-term averages. But the problem is for the banks, because banks are getting disintermediated by the bond markets and the NBFCs. And this is not a cyclical phenomenon. It's a structural issue that we are seeing. Banks have actually lost 20-25 percentage point of market share in last 10-15 years. So the large industry growth or the large corporate growth is also likely to remain tepid for the banks. And the final and the last point is that while cyclically we have seen the banking system loan growth being very strong in few periods, last 3-year, 5-year, 10-year, 15-year CAGR shows that banking system loan and deposit growth has always been between 10-11%. So we need to accept that the banking system loan growth is not likely to accelerate significantly, but it has bottomed down at around 10% currently.
That's a brilliant explanation. I am old enough to have known that in previous cycles as well. Home loans did not pick up when rates were falling, but actually when rates started rising. But that explanation is very good, that banks, don't like the home loan product because of the lower margins when rates are falling. What kind of credit growth are you penciling in at all in FY27? And are you taking into account the lower nominal GDP? For the quarter that will announce the GDP now, August 29th, the nominal GDP is expected to be 8.3%. The budget is looking at it at whatever, 10.5 or something. We're going to have a bad nominal GDP for the full year. So, what kind of credit growth this year and next?
So this year we are expecting the loan growth to remain around 10.5% YOY, and next year it only moves up slightly by 11%. The point on the nominal GDP is correct. The nominal GDP has slowed down for India. So unless the nominal GDP moves up, the banking system loan growth is unlikely to accelerate meaningfully. And I'd like to add one more point here. While we focus only on banking system, if we include all the other providers of credit, including NBFCs, bond, ECBs, etc., the total credit in India is actually growing at 13%. It's already healthy 1.3 times credit multiplier, and that's not a worry at a system level.
No, point taken. Actually, if you take the nominal at GDP at 8.3, then this is a 1.5 times credit growth. Point taken. Wait, I want to come to the big asset quality and MSME question, but people will be wanting to hear from you buys and sells. What would you bet? You're saying that valuations of the big banks are actually reasonable now?
Yeah, so Lata, what we have found is that calendar year to date, for the mid-sized banks, the earnings have been cut between 30 to 70% for even FY27, but they have re-rated sharply from distress multiples. On the other hand, if you look at the large banks, the re-rating has been very, very low. We are talking about only 5 to 15%. And in that context, when we look at next year, we are expecting high teens earning CAGR for the large banks. And the valuations are very reasonable, especially if you put that in the context of the broader Nifty. So the banks delivering high teens earning growth for 12 times forward PE. On the other hand, Nifty delivering only 13-14% earnings growth, trading at 22 times PE. The reward looks interesting from the banking sector from FY27 perspective. Of course, in FY26, there are still some more challenges that we need to get through.
Okay, got a point. Okay, Rikin, something separate from your report, I wanted to ask you. Since you referred to this mid-size banks seeing a 20 to 60% rise in prices, why are you, prominent brokerages ignoring the likes of a BOI, a Bank of Maharashtra, an IOB? They've come from very difficult times and have shown a vertical growth. You are largely ignoring that mid-sized banks?
So we do keep a tab of the mid-sized private banks, and we have liked some of the mid-sized banks even in the past few months. For instance, among the mid-sized banks, our preferred pick at the moment is even RBL. So depending on where we are in the cycle, how much stress they've gone through and what multiples they are trading in, we had been bullish on the mid-sized banks for last 3 to 6 months. But from here onwards, we believe that large banks, our preferred picks are ICICI, Axis, HDFC and SBI. We are relatively cautious on Kotak. We think that the risk reward for them is more attractive. Mid-sized banks, here onwards, the price return will be dependent on earnings growth rather than valuation re-rating that we saw in last 3-6 months.
Okay. Yeah, I saw your valuation chart even for the likes of BOB and all. It is a little pricey compared to these banks. Now, very quickly on asset quality. We saw this very big rise in loans to MSMEs. Your own chart is showing that, ICICI Bank's MSME loan book, 29.5% rise. HDFC, I think some 17 or 19% rise. It's like fairly tagda compared to the MSME credit quality. So should we worry?
Sure. So we actually analyzed the bureau data, and if we split the MSME in 3 buckets, the entity MSME, secured individual business loan and unsecured individual business loans, there are pockets of stress. The common underlining theme across the 3 segments is that the NBFCs, small finance banks, and the low ticket size loans are the areas where we are seeing early bucket and even the NPAs rising. So for instance, if we speak about the unsecured individual business loans, we have seen that stress in less than 1 lakh rupees and stress in 5 to 50 lakh ticket size has gone up. This is the segment which Bajaj Finance also operates in, and they alluded to stress in the last quarter that went by. But if we look at the entity and secured individual business loans, what we have noticed is that the large private banks are already operating at very low levels and are seeing improving trends. PSU banks, the stress has always been elevated relatively for them, but directionally they are not worsening. It's NBFCs and small finance banks where the bulk of the stress is becoming visible, and that's one segment we'll like to operate. But clearly, large banks have also grown. I would like to comment that unsecured retail credit stress is largely behind us or will get behind us in the next couple of quarters. But next pocket to watch closely would be MSME or the lenders.
Oh, yes. I'm just worried, there is this export worries looming. Not all of them are borrowers, but some of them are. But let's hope, fingers crossed. Unfortunately, out of time, Rikin, but once again, many congratulations for an extremely useful and overarching, comprehensive report on the banking sector performance. That's it on this edition of Bazaar and, banking sector analysis. Chartbusters coming up after a break.